Good evening, you beautiful people out there. How you doing? Dustin Tibbetts here, financial advisor with Jazz Wealth. Actually, so I went on a cruise one time, and that's what the cruise director, he would always say, like, "Good afternoon, you beautiful people." It was weird, but it stuck with me. We are financial advisors here at Jazz Wealth, and tonight enjoying the Glenfiddich 12. 12. Nothing fancy here for me tonight. Hope you have a drink, you're ready to hang out and learn something a little bit more geeky. At least I try to make it seem not geeky, because there's a lot of changes happening here inside of the different sectors of the S&P. Actually, big changes, and I don't know why this isn't talked about, but my job as the steward of our clients' dollars, retirement accounts, long-term investment accounts, is to pay attention to all of this stuff, and I find it fascinating, so I don't mind, and it's also my job. But as someone who formerly managed funds directly, these are things that I like to keep track of, and if there's an opportunity, then I like to know about it, or if it's something you should know about, I'll bring it up. But let's take a walk down the markets here for a second, shall we? So, in the S&P, I actually shared this yesterday on a closing beat. There are 11 sectors in the S&P, and inside of those sectors, there are industry groups. And then, of course, inside the industry groups, there are stocks. So it goes S&P 500, sectors of the S&P 500. We can break it apart into pieces to further analyze it. And then from there, those sectors have industry groups. And then, of course, there's stocks that make up all of those industry groups. And the reason they do that is to kind of track performance at any given point of a subset of the market. And it's important to mutual fund managers. It's important to ETF managers, financial advisors like myself, where we actually manage the funds directly instead of just sending them on to a mutual fund or something. We like to be able to see like what's hot, what's not, what's underperforming, and what should we really not have money committed to, and things like that. Well, I won't make this a long one here tonight. On March 17th, which is coming up rather rapidly, I figure the year's gone by so fast. So not this Friday, but next Friday, they're changing the classification of some of those groups. And in turn, some of those stocks, some really big stocks, are moving into completely different sectors. Whereas you were used to seeing them over here in the tech sector, now they're going to be in the financial sector, and there's all kinds of cool stuff happening. What's happening is the group, the data processing and outsourced services group, which was a part of the tech sector. So you got the S&P, tech sector, data processing and data processing. That's all I ever called it. Data processing and outsourcing group. Inside of there, they're going to be just saying, this is done. We don't want this group anymore. We're going to take these stocks in the group and move them on to other places there. They're going to be moving those to financials and industrials. I'm going to share with you a little chart here in a second. I'll explain through my notes, and then I'll show you visually there. So now we have that thing, and then we also have the transaction and payment processing group, which will be established in place of it. Well, we went from saying data processing to transaction and payment processing. Data, technology, transfer and payment, financials. So we're making a switch there is what they're trying to say there. What this will do is it's going to add several growth stocks, I do have it. It'll add several growth stocks actually to the value financial sector, right? It's kind of interesting to look at there. From my calculations, you're going to have about $952 billion worth of market cap as of last night when I did this, which is about 10% of the tech sector is going to move to the financial sector. 10% of the value, right? So when I say 952 billion in market cap, companies worth $952 billion are now going to move over to the financials there. And so financials will, can you guess what's going to happen? Financials will have a bigger say or a bigger weighting in the S&P. If you're not familiar, the tech sector right now almost makes up 30% of the S&P. I think it's 27 to be exact. So until next Friday, the tech sector accounts for 27% of the entire S&P. We're now going to pluck money out and we're going to put that over into financials. So it gives the financials more weight, brings the tech sector down, makes things a little more competitive there, right? You've got Visa, MasterCard, PayPal. Well, those are the three largest anyways. Let me make sure I got them. Yeah. So I've got those on there. We're going to go over a few others here as well. And some services stocks, HR type stocks like ADP. We'll cover that as well, that are going to be making this move. So a couple things here. If you own an S&P index fund, there'll be changes in the percentages of the underlying holdings. The fund itself won't really change. There's no need to. It'll just, rejigger it itself around to where it holds more of these positions there. So that's one of the things there. Now, I did a little research and I looked at the two largest sort of index tracking ETFs there in relation to tech and financials. That's the XLK and the XLF. I always use these on the closing beat as well. They're the most popular. They're the largest. They're about 40 billion in market cap in assets managed and 33 billion, right? Vanguard has their tech ETF as well, VGT. So Vanguard has their VGT. It's much larger. I believe they're sitting at, they're much larger. I can't find the number actually, but it is coming up larger here. So VGT is actually bigger as well. And so there's going to be changes inside of that because the holdings inside of the tech, the VGT or the XLK, no longer apply to tech. They apply to financials. So you're going to expect some changes there. You're going to see, again, based on my calculations here, the average financial stock, did I do financials or just tech? So the average financial stock leading up to that event, March 17th, will have an average daily trading volume greater than a third, 33% of what it normally has. If I've done it right here, and we say, well, we have, if that much money actually moves there. So we have quite a bit of changes, a lot of moving parts here. I should have took better notes. So you'll have, roughly about a third of extra volume there. The tech side of things and the industrial side of things, because of the changes, they're going to have about 60% of extra daily trading or average daily trading volume. So expect to see that there. I'll show you here in just a second what's going to be moving on there. You're going to essentially have $10 billion of net selling in the tech sector and $8 billion worth of net buying in the financial sector. So a little bit confusing there. Hopefully I don't confuse you. But as that move takes place, I'm trying to put that into perspective. Just the XLF and the XLK are 40 billion and 33 billion. Not just them, but anybody that participates there. You have $10 billion of net selling going on and $8 billion of net buying. So we're redistributing the dollars, essentially. That's the moral of the story. Let me show you how this is going to break down. I did my best here. Yeah, there it is. Okay. Find the actual thing. So here's the breakdown. Currently in the information technology, or we just say tech sector, we have ADP, Paychex, Broadridge, Visa, MasterCards, PayPal. These three are the biggest. Pfizer, Fidelity National Services, not Fidelity, Global Payments, FleetCor, and Jack and Henry. These stocks are going to be split apart, and ADP, which is now, that's HR, Paychex, HR, Broadridge, HR, that's going to be considered an industrial stock. So when we refer to ADP, we're no longer going to say in the tech sector, ADP helped move the tech sector higher. It will be in the industrial sector. And notice that, the sub-industry, we're calling it human resource and employee services. I don't reference this much, so I'm not too worried about that. Over here, these payment processors, essentially, are no longer going to be tech-based. They're going to be financials. We're going to call them transaction and payment processing services. So those will shift here. The ones that got left off a little bit but are still making the change, Target will no longer be a consumer discretionary stock. It will be a consumer staple stock. Same with Dollar Tree and Dollar General. Those two always go hand in hand anyways. And so those are the initial changes. I find it odd to refer to Target as a consumer staple. That's how far they've come. That's how these people want to classify them. Visa, MasterCard, and PayPal now moving into financials kind of makes sense, doesn't it? By the way, if I go a little bit right here, I took a paw right to the nose, man, playing with the dog. All right, back to the good stuff here. Okay, so the individual stock's weight in its own sector here changes because it's now going to be comprised of a different chunk of the sector. Okay, so take a look over here, just highlighted in blue. In the financials sector, you now have 15% roughly of just these two stocks. That'll be their weight in the sector. So this is no small move here. This doesn't get talked about too much because Target will be 3.2% of the consumer staples sector, which is high, but not enough to move, really move the needle there. What's really interesting down here at the bottom, currently tech makes up, I got it right, okay, 27% of the S&P. By taking away all of that money from tech and moving it, scattering it around and moving it away, we now have 24%, still a respectable amount, but we put financials now from 12 to 14%. So in the S&P, basically a quarter of it is tech, 14% will be financials, then consumer discretionary. That doesn't change because of Target's current weighting in the consumer discretionary space. Industrials and consumer staples. The big action is up here. What are they doing this for? Why would that happen? You remember 2018, even parts of 2019, where we look, and especially 2020 before COVID hit, we looked at the market and we said, it's going up every day. This is crazy. Every day it's going up. Your brother's trading and everybody's making money trading. Didn't matter what it was. We're all out there making money because the market was going up. People would say, oh, index funds, man, that's all I need to do, because the index was going up. Why was it going up? Because of tech. Just this one little group. I made the analogy that you're on a boat with 7 of your friends and you're all rowing, right? And all of a sudden you stop and only your techie friend is rowing. He can do that for a while. He can keep the inertia of the boat going. But at some point he's going to run out of steam. He's not going to be able to push all 6 of you down the river. That's what was happening back then. And even to start this year, in January of this year, only a few tech stocks, the tech sector, the top half of the tech sector, was actually moving the markets higher. Everybody thought the market was doing well, but in reality, it was this small little subset of the S&P 500 pulling the markets higher because they make up 27% still to this day. They make up that much. They have that much say in the S&P. The goal is to try to move away from that and create more of a broad market. That's exactly why they're doing this. And also, kind of smart, to be honest, like Visa, really? It's not really a tech company. They make money off of processing transactions. The technology's there. They're not like a growth tech company in any way. PayPal maybe could be argued for that, but the bulk of their earnings come from processing the freaking transactions. So being a financial kind of makes sense, especially as PayPal gets bigger. So all of that is a long way of saying you have changes coming here. So I could go over more, but you get the concept there. A shift happening that like nobody's really talking about that will impact your tech-driven mutual funds. Because what happens, by the way, last thing, what happens if you have a tech mutual fund of any kind in your 401k? When those stocks move out into the financials, let's say you had the S&P or financials as well, now all of a sudden, you're more overweight financials and less or underweight technology. So you'd actually have to take dollars and move more dollars in to go back to the same method that you were before. See, because you had tech over here with, what we would say, $900 and something billion. And if we're going to draw out that kind of money and put it over here, what'd we just do? We came imbalanced. So it does have an impact. I do think there's a reason to take a look at what you have, make sure you don't become more overweight financials than you want, or become more underweight tech if that's not what you want either. Maybe you have no financials and you only have tech and you're really heavy into tech. Well, you may end up becoming less heavy in tech as a whole, especially if you're using reporting software or something that shows that. Once that catches up, you're going to wonder, what the heck is going on with my portfolio? Anyways, If you like this sort of geeky stuff and you like somebody that's always watching this kind of geeky stuff, we are, I believe, the only financial advisors that actually spend time talking about this stuff, because that's what we're doing on a daily basis. We manage our own portfolios here for clients. We don't use mutual funds. We don't send it out to some other company. We're responsible. You talk to us, we make it happen because we like our business model. If your account doesn't grow, then us as a company doesn't grow. I don't make more money. Everybody here doesn't make more money. We want to make more money. We want you to make more money. So we go together. If you're curious, you can go to our website, see all about us there. We even, I think, are the only advisors that put our fees on the homepage. So much so it's not even a bad word anymore. That's what it costs. It's on the homepage. Full transparency there. All right, I'm going to wrap it up here and get to bed. It's late here. Enjoy the rest of your evening. We'll see you tomorrow on the closing beat. And thanks for hanging out with us. Adios.